Hi everyone, my name is Ali. A little bit about me. I'm the president of the Cognitive Science Student Society. My own background is I'm a cognitive science major, which means that I take classes from linguistics, psychology, philosophy, and computer science. Uh, Professionally, I have worked about a year and a half in cybersecurity. Latter bit, it was actually machine learning, the intersection of machine learning and cybersecurity. Currently, I'm doing machine learning for robotics. Machine learning is basically using statistics to achieve artificial intelligence. Uh, as for my experience with trading, I started paper trading in 2017. I waited for recession until approximately October 2019, at which point I was more confident in the market. I started off by buying options in a 3 times leverage ETF and in Beyond Meat. Uh, Over here, the first bullet point is my earnings in the 3 times leveraged semiconductor ETF went from 8 to 13 to 17. Unfortunately, I sold at 13. For Beyond Meat, I ended up not selling at a high point because I was looking at the theoretical options pricing. I didn't fully understand it, and I was thinking that the market was not giving me a good price. So I'm like, okay, I'm going to hold. And I thought the stock was also going to keep on going up, though that almost 2 times returns was definitely quite tempting to take and run away. Anyways, I ended up losing everything on that particular trade. After that, between approximately late 2019 to early 2020, I was betting against the market for a very large portion of the time, including in March 2020, but ended up still being net negative because I had a huge loss in Beyond Meat options. I had two contracts. That's a $1,600 loss in the American dollar. I restarted in late October 2020. All but one of my trades aggregated for the security are positive. One losing trade is Taurus International, and I'll discuss that in a moment. Beating the TSX 60, I have a excellent return of in 3 months 22%, and the TSX 60 is like I don't know 26% in a whole year, so that's pretty solid. But uh, I'm not beating the S&P 500, which definitely sucks. I recommend actively trading and trying to find out if you can actually outperform the market and whether it's worth it or not. Because when we're young, our time is cheap and we might as well try out these type of things just for the hell of it. It's not like you're going to lose that much money. I got back into the positives, didn't take me that long, though it was definitely a large amount of stress. Anyways, on the right-hand side, you'll see my portfolio. In early July, I sold 100%, sold everything for at least 2 days and a weekend. I was right, oil did indeed fall, but I bought back too fast because I thought I could day trade it and make a bit more money that way. I ended up buying back around here and a bit more over here, but on this day right here, Monday the 19th, it was a negative 5% day. I didn't buy anything more here, which I don't think it was a mistake because thinking probabilistically, I think that there's a chance you may fall down here. And I'm saving my money to. I can't afford to double down, but I can afford to throw in a decent more amount of money down here. And I am partially expecting a so-called slow bleed down towards approximately this level, maybe shallow, might take a bit of time, but I have no idea. I'm still quite a bit positive in my account. I checked 2 days ago. I'm still at 22.05 or 22.01% for my last 3 months, which is pretty solid. And I'm net positive by in the hundreds. Uh, what I'll cover a little bit about mindset, miscellaneous notes, day trading, talking shit about a professional way. We'll be talking a bit about beliefs, options, technical analysis, and automating all of this. One interesting conclusion is that I can show, assuming my code is correct, that buy low, sell high isn't really a good strategy. A few miscellaneous things. For the traditional method for investing, I recommend you guys check out these two links, in particular the second one. About a little more about my own style. I am probably considered a mean reversion trader. I don't understand fundamentals too much. I do, of course, understand PE, price to earnings, price to book, and earnings per share, but I don't understand how the cash flow analysis and fundamental evaluation and that type of stuff. I personally believe in concentration. I have out of I think I can confidently say out of all the stocks here, except Coastal, I am positive quite a bit. Rogers I'm positive 20%, Thales positive 15. I closed out British positions. All of these I view as a bundle. I'm positive by 23%, and I just view them as a bundle. Like I said, even though I have day trade all of these. Coastal's more of a long-term bet. Right now it's $30. The 1 year estimate is $47, I believe. So I'm confident I'm going to be making money in Coastal, and I could sell cash covered calls right now and make a good chunk of change right there. I'll talk about cash covered calls a little later on, and check out this link. Uh, Little bit about our miscellaneous notes. For brokers, I recommend Rough Simple. That way you have zero commission trading. RBC has a good website, but the commission is high. CIBC has a shitty website, but the commission is low. No matter which of these two brokers you choose, make sure you tell them you're a student so you don't have to pay a management fee. Uh, I would definitely recommend at a bare minimum get Rough Simple, maybe paper trade or start trading with one share. That way your downside is minimum. Like buying your max loss on a share of RBC is no more than how much you is literally your max loss would be half of your lunch money. It's like literally $6. You're not going to lose more than that on CIBC stock. RBC stock is a bit more expensive, but I digress. International brokerage is good for options. Hasty trade is coming soon. I'm excited for both of these. Some good websites: Google Finance for charting, TradingView for charting, Yahoo Finance for fundamental data. Thinkorswim is an excellent good trading platform. In Python, there's Yahoo Finance, and there's another one I use in some of my code, but I don't remember the name. Okay, so a little bit about mindset. If you aren't cheap as hell, you're realistically speaking, you're probably not going to do a good job day trading because you're going to be picking up pennies in front of a steamroller. You have to value the pennies to do a good job. If you're not a penny pincher, good for you is to stick in the macro sense and just trade the S&P 500 in the long term. If you want a bit more excitement, maybe 10x on a level, 10% of your money in a leveraged fund or 40% in individual stocks. Little bit about like my own mindset. I'm the type of person to lose big boy dollars, and on the way to vacation, I'll be reading about really complex math, desperately trying to understand it, so I know why the hell am I losing so much money. Amusing thing was, I did this next to two literal hippies while on the way to vacation. Really just shows the cultural difference between us. Just to illustrate my own frugality, I am the type to go to Starbucks, get a large cup of ice and a $2 Jones soda, and to drink that rather than a $4 coffee. And then I'm the type to refuse to pay $3 transit and instead walk 7 kilometers back home after walking around downtown for hours. Like I was outside for like I don't know 7 hours that day, and then I went and for another walk at night time for dinner. Yeah, maybe I'm a value investor. I'm almost as cheap as Warren Buffett. A little bit about my day trading. Uh, the difference between $40 and $41 is approximately 2.5%. I bought at $40 thinking I could sell it at $41. I was horribly mistaken. On approximately this day, I thought my max downside was around here, max upside was around here, so maybe I'll end up doing well and I should hold. So I did that. But you can see, complete roller coaster. I ended up selling at $39 a few weeks ago. It was a less number of shares because I transferred accounts and my confidence in PIXT wasn't that high. And I always knew I could buy back lower. I do plan on rebuying at this number. I still have an order, but unfortunately, this in the last week has went straight back up to $39 to $40 in the current week. Here's a bit of my trade history. On February 16th, I sold high. On the 17th, I bought back low. March 5th, I sold high, sold high, sold high, bought back $1 higher, $8 less, $6 less. So yeah, picking up pennies in fun for steamroller. Time to talk a little bit of shit about the professional world. In terms of uh, diversification is like one hell of a diminishing returns. And my own issue with diversification is twofold. First, if you don't like tech stocks, don't buy them. Secondly, don't buy stocks just for the sake of diversification. I think that's incredibly stupid. The only time I would diversify is when I think they are, when I have multiple stocks I am confident in, and all of them have the same high expected value, and I'm just worried about an unexpected event screwing over one stock, so I want to diversify into another stock, but I won't diversify at the cost of expected value. If I think RBC isn't going to make me much money, I'm not going to buy RBC. Uh, on for rebalancing, it literally retards your top performers by shifting your weight into your low performers. I think that you should perhaps reward your top performers, but I'm a mean reversion trader or reversion trader, whatever it's called. So my strategy is known for not doing this, but it's to my own detriment because stocks that go up will often continue going up. Like look at Amazon, that shit just keeps on going higher and higher. Same thing with Apple, Microsoft, Google, so on. I don't buy tech stocks on my own, but that's probably a screw up and a horrible mistake of my own. And you should definitely not look up to me for that in particular. But this is loosely weighted. If you look at an ETF, that oil ETF equally weighed versus weighed by market cap, 5-year returns, majority of the time periods, meaning majority of the x-axis, the market cap range is superior returns. So maybe it's better to favor your top performers rather than treating them all equally. In other words, communism is bad. Okay, so efficient market hypothesis. You have a lot of people competing. The amount you make is solely dependent on the risk. I'm not a fan of this because, according to Nicholas Nassim Taleb, outside of casinos or the minds of people who call them risk experts, risk is not measurable. Furthermore, maybe you're straight up the smartest person, or you behave in a very different manner. For example, male peacocks are the ones you think of when you think of a peacock. And that's basically the mating strategy. The males are good looking, and that's just how they are eye catching. Unfortunately, it doesn't work very well with respect to hunters, but I digress. Maybe you are the smartest, so you think differently, and you're like, I predict cybersecurity ETFs are going to do very well. That's actually a prediction of my own. I did not take my own advice, even though I put in an order for NET, but I ended up not getting filled on it. I think it was at about this time. I was like, or maybe it was, I don't know, some time, and I just didn't get filled, and it just kept on going higher and higher. I think this was during September, October 2020, but I don't remember the date in particular. But that's what happens when you lowball the market. The market doesn't give you what you want. For example, maybe it was here. It ended up going higher, not lower. My order didn't get filled because I was saying I'll only buy it less than $39. And they end up going higher. It goes even higher. I still refuse to buy it. Never got a chance to buy it. I didn't lose any sleep. I make enough in oil at least. Anyways, so that's a little bit of a mindset. Recommend you check out these two readings. Tiny bit about credence, which is the cognitive science word for belief. And the issue I have here is I do want to recommend you reason in a probabilistic manner, but you technically don't have a model of the environment, and therefore me recommending you to reason in a probabilistic manner would be utterly ridiculous because you couldn't have the probabilities by definition. So I would recommend you reason with your beliefs. So if you have a coin flip, you actually know the probabilities because you have a model of the coin. 50% for heads, 50% for tails, and epsilon probability for getting landing on the edge of the coin. It's a 1 in a billion chance, so it's epsilon 0.00001 or whatever the hell. So you would have an 80% belief of winning this and a 20% belief of winning 30. These should be beliefs, not probabilities. Uh, these are quite hard, but interesting things to Google. Maybe read the first paragraph in the encyclopedia. Things, resources that are not the encyclopedia are a lot more approachable. This latter concept right here was originated to minimize sin in times of uncertainty in like the 14th century or whatever the hell. I recommend reasoning in a probabilistic manner for mean reversion, momentum strategies, CCI, RSI, and MACD. Just think probabilistically and almost like dollar cost average it as time moves on. Don't just buy all in at one point. You want to be like, okay, what happens if shit doesn't go the way I expect it to? Maybe I expect to put in half my money if I'm wrong. And if I'm right, I don't make that much, but okay. Anyways, now a bit about options. You can do something called a covered call in which you cap your gains at X in exchange for instant profit. So, Coursera right now is $30 at the time of this making this presentation. You can cap your gains at 40 for $6 right now. The minimum you make is $6 and the maximum you make is $6 plus $10. This is kind of like minimizing your downside at the cost of your upside, but maybe you don't want to hold it past 100% or whatever because you're a paper hands. So you could exit out of this position. Though options is really complex, you have something called implied volatility, and there's a chance that your option may increase at the same price as the stock, and that might eat away on your gains. But I digress. I don't want to explain this because it gets really complicated really fast. Uh, you can use options to profit off of someone else's shares in exchange for flat fee. This flat fee is also your maximum loss, but you profit off of someone else's shares getting a delta of 80%. I'll explain this later. Alternatively, you can sell something called cash secured puts. You're forced to buy at price X if the price falls below price X. In exchange for money now, note the if. This is not guaranteed. Once again, think probabilistically. If you think in terms of a computer, you will be thinking this is a shitty idea. But probabilistically, this is a viable strategy. I bought Rogers at $54 and I sold it at 66 because I thought it was overvalued. I can attempt to make more money off of Rogers by selling cash secured puts at $50. If the stock falls to $30, well, I'm willing to hold this in the long term. Realistically, it's not going to fall to 30, it's going to fall to maybe $44, and my commission for doing this is going to be, let's say, $3, $4, $5, whatever. So that definitely minimizes my downside. And if it keeps on going up, well, I keep a few dollars and I don't have to buy the stock. So in that case, it's like beating the interest rate in exchange for taking on risk. Here's an example of call options. If you own calls at a delta of 1.1, that means you get $1 for every $1 the stock goes up. One contract consists of 100 shares. If Apple is $10 and you have to buy 100 shares, that is $1,000. So, yeah, $1,000. Don't accidentally want to add a zero. However, the option would perhaps be $100, maybe a few hundred. I don't know the options price. This is a on paper example. This $100 is your max loss. This gets you cheap leverage because You will make $1 for every dollar the stock goes up. Note the bid ask is fake news because something called dark pools. You should read up on it. Uh, the percentage gain is huge. If you make $1 a share when your cost for the option is $1 a share, that means you got a 200% gain. But for this, that would be a 10% gain, I guess. Yeah, 10% gain. 10% gain for buying the stock itself, 100% gain for buying options on the stock. Yep, 10 times the leverage. You get to minimize the downside. Pretty good idea. Also, why this is a good idea when I talk about my absolute fuck up in Beyond Meat, which will be a few minutes from now. A little bit about technical analysis. You can do something called feature engineering, which is the concept for machine learning, and that is you basically give your machine learning model, which is your regression model, multiple inputs in hopes of helping it get to you a better prediction. So let's say you decompose a signal into the constituent sine waves. So if you have this, you can model it with 100 sine waves and get this red line that you can't even see. Or with 9, you can get this green wave that is like pretty close. It's a pretty solid fit. So maybe if you have 30 components, that's a solid fit. That's a solid trade-off between accuracy in modeling and potentially overfitting your data. Anyways, good thing about this is that you can exploit into the future without having that much of an issue. Uh, people call, how do I say this? People partially argue in favor of random walk theory because they can say the market is random and it becomes really easy to model. But modeling the market if it's not random would be a significantly harder task. Before moving on, I'm just going to mention when I wanted to do this strategy right here of cash secured puts, I did not have permission to do it on my trading account. I gave RBC a call. They basically called me a broke bitch and told me to go fuck myself. I asked them why, and they told me that I required $50,000 in my account to be able to do this, even though my maximum downside would be, let's say, $50 times 100 shares. But they wanted me to have uh, $50,000 regardless of what trade I wanted to do, whether I just wanted to sell puts or cash secured puts in which I have a defined downside or whatever. So yeah, this is the one place in which banks are really going to screw you over for not having enough money. But realistically, for these two strategies, you have cheap leverage. No one can discriminate against you. The world is in the palm of your hands, and you can go live the skull-face fantasy, I guess. Just don't do a mountain of coke and end up doing something really stupid. Though it is a well-proven fact that coke makes you temporarily bulletproof. Anyways, oh look, a soul loser. Okay, now I'm going to talk a bit about our technical analysis. But first, let's have a quick 1 minute break. This meme is regarding when people on Wall Street bets decided to go in and buy GameStop and make the hedge funds lose millions, something like $20 billion or something. And people were saying, oh, maybe we should sell out, take my gains, go on vacation, spend it on myself, whatever the hell. And some people are on a straight up crusade and they're like, yep, I'm donating this money in my crusade against hedge funds. So, yep. Quick shout out to my own code. You can run anomaly detection, which is a concept typically in fraud detection, anomaly detection, or yeah, of course, anomaly detection is used in anomaly detection. No shit. But yeah, this is used in fraud detection and cybersecurity and possibly other things, such as detecting when a ball bearing on a motor is significantly deteriorating or some crazy shit like that. It is what it sounds like. It's related to outlier detection. Anyways, this algorithm was kind of able to tell you when you're in the low point of a market. It can tell you when it's perhaps doing the market is doing something weird. You can point out these low points, and I can tell you when it's really overvalued, such as here at these points, maybe at these points. No, it's not that great, but maybe it's amusing. Here are a few resources I recommend. Two blog posts, series of videos. These two definitely recommend. This one I don't remember what it is, but at the time of adding this onto the list, I recommended it, and I still recommend it. These are basically like lecture videos. If you don't know about probability, stats, or Python, you have these videos. Uh, this is a repository I'll refer to today. This is a repository. Hopefully, I will have another presentation on. This one is about taking Wall Street Bets words off of Reddit, making them into vectors, and using those vectors as well as inputs of a whole bunch of stocks, sorry, as well as the data, I mean the closing price of a bunch of stocks, and using them to predict stocks in the next day. So it's basically using current data, including language data, to predict future, immediate future. Anyways, let's move on. So here we have Beyond Meat. I bought my options on approximately, I put in my order for the call options on this day. It got filled on this day. I lost a shit ton of money. And my rationale was that, okay, we are at a CCI of negative, but if I move it to a CCI of 20, we can see that this is at negative 100, and typically this shaded area will be at plus or minus 100. I just personally use 200, and it is debatable whether you should use a length of 20 or 40. It is up to your own preferences and onto the nature of the stock. There is also the RSI and the MACD. I just use the CCI myself. So I thought that we're going to have another spike like this at approximately this time. I will go in, make some profit. Perhaps at this day it would be at this price. I would sell, easy money, maybe double my money, maybe triple, whatever. And I was partially right. I bought it at $8. I could have sold at $15. I remember this day quite clearly because all the pain I was in these days right here. I did sell. I thought the market was giving me a good price. I got screwed over. Yep, got to cry myself to sleep and lost like $1,600, I believe. But it's a good thing about options, maybe, because imagine how sad I would be if I bought it at approximately 160 and over here from approximately November to December. So that's November, October, December. Literally a quarter of the year, this piece of shit was at $80. By the way, a small amount of justification on my sides, on my trade between this day to this day. Maybe six companies that you all know about went into partnerships with Beyond Meat. It was maybe like Tim Hortons, maybe A&W, maybe A&W had their own version of it. Burger King, other companies, they were even selling Beyond Meat at Costco. So between fast food partners and Costco, I thought Beyond Meat was going to be the next big thing because of course there's the social and by social, I mean like human social, as in you get to signal your virtue to your friends, and that factor was supporting Beyond Meat, because apparently people will think highly of you if you're vegetarian, for whatever retarded reason. But anyways, maybe it's a good thing that I bought options because it minimizes my downside. And just to hammer the point, it wouldn't matter to me much if it's at $100, $80, $40 or $0. My loss is the same, doesn't really matter to me unless my contract expires deep in the future. I'm intentionally not explaining this well because the YouTube videos will do a better job than whatever I can do. Anyways, this is one trade I am going to be doing myself in the near future. Matter of fact, I even have an order out for this. Okay, so let's look at earnings right here. Rogers absolutely fell, went up a bit, fell even down. You can see the CCI went below 200, attempted to recover, stayed down. Now I will explain the interpretation of the CCI. Most people who look at the low point have decided at either negative 100 or negative 200. And the other interpretation is that positive is bullish and negative is bearish. And right here we can see that yes, we are at negative 140 CCI, but we're still not at below negative 200. And if I was to move this to a length of 40, all of a sudden, we're not even at a length of negative 100. So like, I'm not in any hurry to buy. I'll buy it when, for example, over here, after dividend, not even after earnings, it was a massive drop, went to a CCI of negative 200. I bought options approximately here at $10. It fell to $8, and the option ended up selling for $12. But later on in the same day, it went to $14. Now it's at like $16 on this day. Now it's probably at $13 or whatever. At this day, would have been about $17. My bad. But that's RCI Jan 2023 strike price of $50. I bought this for $10. It went to 8, then went to 12. I sold it for 12. Then went to 14, then 16, then 18. Now it's probably $13. Anyways, I think I can buy it for $62 and have a huge order in at this price. I'm happy if at this price, I'm happy holding for a matter of years. I think this is something I'd be happy holding during a recession. It has a price to earnings of 20. Anyways, let's just look at all stocks real quick. Oh look, at this day we touched a CCI in negative 200. However, I will mention that sometimes the CCI will hit a low point like right here, and the stock will keep falling even though the CCI is increasing. I call this a slow burn because the stock is just burning down, collapsing on itself slowly. And perhaps that's what will happen right here. We have a drop, and maybe there's another drop. Why would you want to? I perhaps bought here, didn't buy here, went up here. I'll uh, I'll shut the fuck up, keep calm, and wait to buy more at an even lower price. And I save time and stress between these points. And of course, I decrease my exposure. Uh, by the way, in terms of investing mindset, hmm, regarding investing, but what the hell I can spell? This book is probably one of the best investment books that is not related to investing that I've ever read. And this relates to this is called a FOMO, fear of missing out. And this has like a chapter or two of this book, and the core message of it is simply to not display neediness. And neediness and fear of missing out, according to me, is damn near the same concept. So yep, I definitely recommend that book. This is a decent article that I haven't linked. Anyways, moving on. Just want to keep that open. Uh, Here I'm just going to run through seasonal decomposition and detrending. We have our ETF, JETS. It holds a bunch of airline stocks. And an interesting thing we can do with this is that we can, by the way, always read the documentation. There's this thing called HP filter. It will give you a trend and a cycle. But if you read the documentation, you use this parameter here, and this will be the trend, and this will be the cycle right here. Anyways, this is what I want to talk to you guys about. Stats model.tsa.seasonal dot seasonal decompose. You take your stock, which is the observation, it will give you a trend, a seasonal component, and a residual. And you can take the trend and the seasonal, plot it, and you get this blue line right here. The observation is this green line. And perhaps you could trade based off of the seasonal. If there's a strong seasonal component, maybe that really matters, and you can trade based off of that. Maybe you want to hedge against these seasonal, this 3 month seasonal, so maybe you always buy puts as insurance on your stock, and maybe when you think it's going to drop over here from the seasonal, maybe you buy a little bit of call options as well, just to like inflate your gains. Maybe you expect this like here to happen, so you buy out of the money call options, and then you hold it for a little while, get it closer to in the money, and then sell. In terms of the derivative of the amount of money you make, buying out of the money call options when you're timing it right is a very good strategy, but you have to know what you're doing. And options is perhaps 2 to 5 times the difficulty of stocks after you already understand stocks. So options is, it gets really complicated, especially if you want to strive for perfection, because you are dealing with several variables such as strike price and expiry date, and you can do combinations of options, and you can have one options trade that consists of several different options contracts. The videos I have put you guys to explain that quite well. Just for fun, I noticed that often when you're detrending the time series, you're subtracting out the linear regression. But what happens if you were to do the polynomial regression, or the ninth degree polynomial regression, or even the 48 moving average? So I was like, okay, let's try this out. Maybe it'll be interesting. I have no idea what the hell is the point of this, but I did it because I could and because I was curious. And like I told you about male peacocks, uh, if you're not the smartest, maybe you should just have new ideas and try them out. Anyways, here's some code about looking at the constituents of or the underlying holdings of an ETF, which is a bundle of stocks, and its correlation. We start off by getting some of them. Perhaps you could get all of them. This is faster and easier for visualization. We plot them, not very useful. Let's normalize and subtract by the first number. That way we start at 0. Oh look, these are pretty correlated. Here's the ETF on its own. We have a correlation matrix, Spearman correlation matrix. This leads to how this is a bad explanation, but you can think of it as relatively how much is it monotonically increasing or monotonically decreasing with respect to each other. You don't know what that means? No worries. Wikipedia and Google will help you out, and this honestly doesn't matter that much. Perhaps this is beyond retarded, but maybe you can take the cumulative sum, and this will tell you relatively how correlated to authors are each of these. And my intuition is that if I take the most correlated, I can use that as input into a regression model, and I can use these several stocks to predict one stock in particular, and perhaps I can add in technical indicators and other things as well. Anyways, let's move on. We take our top, one of them, CVE. In my data set, I didn't mention this. I included Servon and ExxonMobil that are not even in XEG. And CVE is extremely correlated to XEG, so I'm keeping that because maybe it has predictive power. And you can try to do a bunch of machine learning I honestly don't like this code or the models that much for this particular use case, but it's here because why not? Uh, this talk isn't covering machine learning, so I'm not going to bother discussing it. Uh, it's we're going to have another talk on this in a few weeks, and this is a concept that is a whole different field on its own, and it's very difficult to trivialize it. And to be honest, this code of mine isn't that good. It's just an afterthought I added in. Here's some code to compute the theoretical price of an ETF because you know what the ETF is holding, you know how much cash it's holding, and you know the current trading price of the individual stocks. So we have a function called getMarketCap. We have our symbols. A little bit of the money is going to be in cash. We have the weights. We can normalize the weights. We have how many shares still holding. We can have how much cash still holding. And you have the computed stock. You want to do the computed price, and you want to have the computed price and do a little bit of math here. The code speaks for itself. I don't think I can do a better job explaining. And basically, you have the expected stock price, which is the stock price at which is the actual price of XEG, and then you have the computed stock price, which you will normalize by the shares outstanding, and we find that the theoretical price is greater than the current trading stock price, which is $30, $8.31. So according to this code and our underlying assumptions, right now this ETF is undervalued because what you get is much greater than what you are paying for, which is the stock price at this moment. I think our assumptions are wrong and that the data we got from the official website is not up to date enough. But if you had up to date data, and perhaps if your assumptions were all correct and your computational method was correct, then maybe you would be able to algorithmically trade exactly this, which is you have your price that it's trading at right now, you have the price that you think it should be trading at, and you can buy and sort accordingly, though the market might have a bit of an offset unless you have major hedge funds doing this also and keeping the market quote unquote efficient. And this is kind of where efficient market hypothesis comes from. All of these ideas, someone else has already thought of them, and they may have already implemented them and may be profiting off of them. Anyways, let's continue to some other interesting things. Uh, this further code will show you uh, whether you should buy low, sell high, or buy high. Sorry, whether you should buy low and keep holding or buy high and keep holding. First off, there's a tiny intentional bug in this code because I quite literally can't care less. Uh, this says invest per month, but it's actually invest more money per day. This assumes you're going to invest $1,000 more every day, but with one line of code being changed right here, you could change that. Yep, you could indeed change that. But unless I'm mistaken, this doesn't matter. Anyways, buy and hold strategy, it gets you this much money. Now, what happens if you were to only buy below the simple moving average? And if it's not below the simple moving average, we'll keep the money in our pocket and we'll buy it as soon as we get below the simple moving average. Of course, choosing the number we want to use is difficult, so let's try a whole bunch. Buying below the 10 moving average, we improve over our buying dollar cost averaging strategy. But if you want to buy below the 20th, 30th, 45th, 90th, 180th, 360th, 720th moving average, it's not going to work out for you. But the 10th moving average, that's decent. So I think that I think this beats dollar cost averaging. It's not glamorous, it's quite basic. May not hold this I don't have a training data set, so I don't, so I can't say with certainty if it's going to work out in the future because stock the stock market itself might change. But according to the model, according to the idiots who believe in random walk theory, the stock market is random and will never really change except by standard deviation. But I'm not going to get into a massive rant about that. But you can also do this exact same thing, but for simulating whether you should buy above the moving average and keep holding. And once again, I tried a whole bunch of numbers, and we find that uh, we should buy above the 98-day moving average, and we have one hell of an improvement against all the other combinations. Now, realistically, you should increment this by one and find the exact best number, and then make a few assumptions about the behavior of the market in the future, and try to get the best best simple moving average strength possible. But that's really just a bit of optimization left as an exercise to the reader. But anyways, this is a simple way to beat dollar cost averaging. Maybe you find this amusing. This is what I mean by try out ideas by your own curiosity. This is finally my last example using the CCI. And over here, what we do is I plot out three different CCIs: window size of 20, 30, 40, and I honestly don't know how to choose the constant I tried to do. This is the one I settled on. They either take my word for it or try out the different constants on your own. Maybe read the formula and you'll maybe gain some insights if your math is good enough. You can do a bit of overlay to find out the difference because having them one on top of the other isn't that meaningful. So you can see that over here, high and low is 250, high and low is greater than 250 because it was forced to go above in a greater bounds. You can kind of, oh, here went to negative 500. This did not go to negative 500. So it's kind of like the scaling or the squeezing kind of, even though you're looking at window size. Anyways, I decided to go with a 40-day window. And let's plot the days in which we are up. Let's plot the days and make them green if we are below negative 75. So perhaps these are the days we should buy on. And this is how it looks like in terms of the CCI in a horizontal line. Now you might be thinking, is this a good strategy? Well, that's what we're going to talk about down below. We have our dollar cost averaging strategy. This is how much we would get. We have a double for loop parameter optimization. I think there's a bug in this. There's probably a bug in this. Nah, it's definitely a bug, but still, this is the result from no strategy. Here's what the CCI looks like. Now, let's test it. And to discuss what we're doing in terms of the code, if the CCI is greater than our upper bound and we're allowed to sell it, we will sell it. And if our CCI is greater than the lower bound, we will buy it. This might be a typo. I honestly don't know. And we have this one idea called if we're allowed to sell it or not. This would be the equivalent of if lower is less than the CCI, in which case we buy it, which I believe would be correct. Sometimes if something is confusing, you should just flip it and hopefully that will make more sense to you. Uh, now, we are, for this example, not permitting selling, and that is different from this double for loop. So if we don't permit selling, we find that if you only buy below the negative 30 CCI, you're not outperforming dollar cost averaging. If you buy it whenever you are less than a CCI 0, you're not outperforming the dollar cost averaging. However, If you buy below the negative 75 or the negative 150 CCI, then it is of benefit. And uh, in terms of quantitative finance, this is literally chump change. This is not particularly beneficial. However, in terms of the psychology behind it, I would argue this is quite literally worth its weight in gold because you, under this, assuming it holds in the future, you are only allowed to buy on these red days. And psychologically speaking, this makes you not have to buy on these peaks. And when you're supposed to buy, you can be reasonably certain that though it may fall more, you're still not getting absolutely ripped off. And I think there's massive psychological benefit to this. So yeah, this is my idea about using the CCI for algorithmic trading. Beating dollar cost averaging is really damn difficult, and I haven't used machine learning for algorithmic trading, but I think that's the next step. Incorporating multiple technical indicators together, such as the CCI, MACD, and simple moving average, and adding a little bit of prediction to it, as well as using several stocks and technical indicators for the prediction component. And that would, of course, be quite complex, but I think you could have something worthy and possibly even people worthy, though it may not be a conference paper. On the closing notes, I'd like to quickly talk about this article. It will show you about resampling, which means if you have hourly data, you can make it into monthly data. You can have candlestick charts, percentage change. You can show that you could make the argument that the daily change is not a normal distribution, but rather a fat tail, and there may be a skew to it. And that skew would quite literally serve into your face what tail risk is as applied as demonstrated in finance. You should read about excellent reading by this dude, Nicholas Nassim Taleb, talks a lot about tail risk. He has books called Anti-Fragile and Black Swan. Anyways, uh, this post does talk about uh, autoregressive integrated moving average and vector autoregressive models, which are more of the traditional finance ways of predicting the stock market from like the 80s, 90s, and whatever the hell, which are different from the machine learning which I'm experienced with doing. Anyways, uh, anything interesting I want to show you guys? Hmm. I'll just show you guys the charts real quick. You can do this in Python, which is kind of cool. Anyways, next post. Uh, you can use something like Fourier transform, like I showed you guys earlier, to model the stock market. That way you don't have to assume it's random, and these lines, they will possibly hold true or decently accurate in the future. Furthermore, you could use something like Avima as a input into your neural network, or you could use a technical indicator or something along those lines. And when you have, let's say, a shit ton of input variables going into a machine learning model, you can do something called feature importance, which is in many algorithms such as XGG, XGB boost, cat boost, and many tree-based methods. And it will tell you the it will tell you the feature importance of the different inputs. So according to this, you can see that the MACD is relatively important, while the 26 exponential moving average, which both of these are involved in the computation of the MACD. So with this, you can tell that arguably you should get rid of this right here because it's more data for your algorithm, but it's not that important. Same thing as the 20, I guess this means standard deviation. I believe these are the Bollinger Bands, spelled boiler bands indicator. These are the last two. Boiler bands indicators involved standard deviation, but it's not just a standard deviation. We can see that it was relatively more important to this particular algorithm than just the standard deviation. So perhaps we would get rid of the 26 exponential moving average as well as the standard deviation. Also, you could use something like you could use a Bayesian dense layer in a neural network. Bayesian is misspelled, but who cares? Uh, and yeah, that's basically the last bit of associated things I wanted to talk about. This is some decent code, decent code. This is some pretty good code related to one of actually both of these repos are related to some of the resources I listed. And if you want to reach out to me, here's my email address, and my GitHub is alik604 at alik604. So yep, that's it. Hope you guys learned something, and good luck with whatever you're doing.